Hello, and this is Global Business Insights, where we look deeper at the headlines from a business perspective. First, some good news. Germany's industrial sector returned to expansion in June. Industrial growth output in the Eurozone's top economy increased by 1.4% month on month, as against an expected increase of 1.0% and a 2.5% drop that we saw in May. And in the US, Kamala Harris overtakes former President Donald Trump in the polls and picks up Tim Walz, Minnesota's governor and a former high school teacher, as her running mate. Japan's Nikkei bounces back after its worst day in decades. US markets also rebound, but the fear, volatility, and uncertainty may not be completely over. On Monday, we saw the rising yen driving selling pressure from investors repaying their yen debt, also pushing prices of US equities down. A broad downturn in US economic data hit risk sentiment and rekindled broad market fears of a recession. All sectors of the market were positive yesterday, with technology sector up nearly 2%. Today we get weekly mortgage applications data as well as the Energy Information Administration's report on US crude oil inventories. The next important economic data release, that's July Consumer Price Index, will be out on the 14th of August. China's imports grew the most in 3 months as exports growth slowed. Imports were up 7.2% in July in dollar terms from a year earlier, significantly more than expected 3.2% gain, while exports expanded 7% below a forecast of 9.5%, also leaving a trade surplus of $84.65 billion for the month. Elon Musk has accused the advertising group's initiative called the Global Alliance for Responsible Media of coordinating a pause in advertising after Musk bought Twitter for $44 billion in late 2022. Kenya's central bank surprised financial markets by cutting its benchmark interest rate for the first time since early 2020, providing some respite to consumers frustrated by the high cost of living. Governor Kamala Harris said the Monetary Policy Committee lowered the key rate to 12.75% from 13%. Welcome back. First, some company news. Disney has raised its streaming fees for Hulu, Disney Plus, and ESPN Plus as streaming bundles become more expensive for those who want an expansive playlist and options. Disney will report their earnings later today. With the mood on sensitivity to prices, let's see the impact higher fees will have on subscriptions. Uber reported 16% year-over-year revenue growth, posting $10.7 billion in revenue for its second quarter against estimates of $10.58 billion. It was an all-round earnings beat for Uber, as it also reported adjusted earnings of $0.47 per share versus an expected $0.39. Airbnb stock, however, fell 14% in after-hours trading to $112.21 when they reported revenue for the quarter ending in June, $2.75 billion, up 10.6% from the same period in 2023 and above analyst estimates of $2.74 billion and the company's guidance of $2.68 to $2.74 billion for the next quarter. However, earnings of 86 cents per share were well below the estimate for 91 cents a share and down from 98 cents a share a year ago. Again, we continue to see in corporate releases more of a mixed bag than we saw in quarter one. Let's look at US markets, where we see many buying the dips as sentiment improved and the return of risk appetite was reflected in the pullback in the VIX, that is the so-called fair gauge that shows investor expectations of market swings over the next month. Market concerns were exacerbated as investors wound down yen-funded trades used to finance acquisition of stocks for years after a surprise Bank of Japan rate hike last week led to appreciation of the yen. Traders see a 75% chance the Fed will cut rates by 50 basis points at its next policy meeting in September, and a 25% chance of 25 basis point reduction. I think that's a bit optimistic, but we'll see what happens. Stocks also sold off after the weak economic data raised worries of a US recession. However, gold prices have dropped below $2,400, extending its losses amid what we are seeing as an improvement in the market mood. US Fed Chair Jerome Powell has been cautiously signaling interest rate cuts for September and beyond. The plan is to lower rates in tandem with declining inflation and provide the economy with some support without reigniting price pressures. Investors are calling for the Fed to take emergency action to lower rates now rather than wait for September. But the Fed will not want to be seen as led by markets. It's too early to suggest the hard landing is inevitable and a future recession is not imminent, but cannot be ruled out, though some indicators like rising unemployment are red flags. Goldman Sachs economists also raised the possibility of a US recession in the next year to 25% from 15%, though they cautioned the risk is limited. It's unlikely, in my view, that the growing cry calling for an emergency interest rate decrease before September meeting or 50 basis points rate cuts will get much attention. The next big opportunity to signal next steps will be when Jerome Powell makes his speech at the Jackson Hole meeting on August 22nd to 24th. Markets are considering a US judge ruling that Google illegally monopolizes online search and related advertising. Google owner Alphabet's inevitable appeal means that the legal process is likely to take a while to resolve, as the government wants some form of structural relief. That means Google may be pushed to break into smaller chunks. The argument might be that the actual search engine should be spun off into a separate business from YouTube. That was the $1.65 billion acquisition in 2006. Or Android, that's a firm bought for $50 million. That was in 2005, which now runs on the majority of smartphones. Also, Apple's lucrative deal with Google could be under threat. Google pays Apple $20 billion annually, or about 36% of what it earns from search advertising made through the Safari browser. That's for the privilege of making its search engine a default on Apple devices. Undoing this deal could mean a 4 to 6% hit to Apple's profit, and we'll see how that develops. The pact runs until at least September 2026, and Apple has the right to unilaterally extend it for another 2 years. Analysts see a most likely outcome to stop payments for default placement, instead requiring Apple to proactively prompt users to select their search engine rather than setting a default and allowing consumers to make changes in settings. The bottom line is that regulatory headwinds are well arrayed against bigger tech players, and the regulators want to see competitive strength of the likes of Google weakened to support better fairness in competition and nurture the smaller players. Of course, the big tech sector are not going down without a fight, and an election year in the US, I suspect, plays to their advantage. Kenya Central Bank's Monetary Policy Committee cut its main interest rate by a quarter percentage point to 12.75%. Kenyan President William Ruto is acting to ease the worst crisis of his near 2-year presidency as protests over tax hikes turned violent, forcing him to scrap deeply unpopular tax increases meant to reduce public debt, which are standing at about $78 billion. The Court of Appeal also annulled the controversial tax hikes that were adopted in 2023. Ruto has sacked most of his cabinet in July and aims to form a national unity government. The annual inflation rate in Kenya was down to 4.3% in July 2024, also the softest since September 2020, and down from 4.6% in June. and below the 5% midpoint of the central bank's target range. That means a very strong and positive real interest rate of 12.75 minus 4.3. That is plus 8.45%, presenting a compelling case for investors. While Nigerians are also protesting the high cost of living, inflation accelerated further to 34.19 in June 2024. So the Nigerian central bank is in a far different position. We are seeing high negative real rates. That's 26.75 minus 34.19. That is minus 7.44. On August 15, we will get July inflation, which some have said may still be inching up, given pressure on the naira as funding of FX markets still remains somewhat challenged. The big lesson from Kenya's economy is that the handshake between fiscal and monetary levers have to happen properly to bring inflation in Nigeria down. Still on Nigeria, the Central Bank of Nigeria granted an approval for financial accommodation to support the proposed merger between Unity Bank PLC and Providence Bank Limited, a move designed to bolster the stability of Nigeria's financial system and avert potential systemic risks. Also, Nigeria's revenue share, that is dividend from Nigeria Liquefied Natural Gas NLNG Limited, has plummeted by 43% due to persistent gas supply challenges. Again, oil and gas sector facing headwinds in Nigeria. Asian markets today extended their recovery as Bank of Japan Deputy Governor Shinichi Ushida said the central bank won't raise interest rates when financial markets are unstable. That boosted risk sentiment. Oil prices also remained volatile as concerns about waning global demand override the risk of supply disruptions in the Middle East. Well, that's it from me on Global Business Insights. This is Bode Oshasami. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Again, thank you so very much for watching. Bye-bye.